my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. The main driver here since late spring and throughout the summer as well as going into autumn has been the construction of the June to date double bottom pattern. It is a lopsided double bottom, but it is nevertheless still there. The market has most recently been scaling upwards on the second part of this double bottom. Prices came ever so close last week to confirming it as a pattern, but bottled it in the middle of last week. As I actually said in my commentary last week, you would need at the very least prices to exceed and properly exceed the 50% Fibonacci line, the June to October 2018 move at 22.21. End of quote. Well, prices did not manage that, peaking at that very 50% Fibonacci line last week, and since then dropping down most recently through the long moving average, currently 21.18, and testing a newer and perhaps more important support. You see, last week I drew a late September to late October bullish Andrews pitchfork. This is a very steep looking one, so its lifetime may be limited, but up till now it works, though the market is currently testing the lower time, currently at 20.88. I'm quite prepared, should this bullish Andrews pitchfork fail, to draw a shallower bullish shift pitchfork in its stead for the same move, but first let us see if this bullish Andrews pitchfork holds. The reason why I'm reluctant to retire this pitchfork, even today, is due to one simple pattern. I actually still think this is the most important thing here of all the things I've spoken about. None of this current rise would have been so good and so clean without the aid of one specific candlestick pattern 3 Mondays ago. 3 Mondays ago, the market made a combined immediate countering key reversal up, bullish closing long white Mariposa, and a bullish belt hold pattern. It is the last of these 3 excellent patterns, the bullish belt hold, that I wish to highlight. Belt hold patterns are relatively rare, but when they happen, you pay close attention, as they seem to be, by a country mile, one of the most potent patterns, in this case bullish, most potent bullish patterns out there. I'm minded to pay attention next week to look at the 22.21 level overhead and the lower time to see which one will be the one to give way. And I'll leave you with those thoughts. LME 3-month tin. Story since late June here has been a series of stratified support levels. In late August, it became a series of stratified resistance levels. The major ones overhead are at the following levels: between 23,000 and 24,155, then 21,360, and then 20,435 to 20,510. More recently, the following levels acted as support. Then in October, the market broke down through these levels before turning back up again and recovering and becoming support again. These are at 19,270, 18,810, 18,590, and 17,525. The descent ceased 3 weeks ago and the market turned higher, prompted by congestion at 17,525 and just ahead of the September 2020 low at 16,970. This pullback overcame some, to be honest, lightweight resistance, but then tackled and punched up through the now flatlining short medium moving average, currently at 22.35, through the slowly declining medium moving average, currently 22.075, and pushed up through the banded area of resistance which I'd previously mentioned, between approximately 23,000 to 24,155. Last Wednesday was a high water mark for this move higher, with prices pushing up clear of the congestion band, but then running foul of another older congestion band between 24,750 and 25,050. And that's dating from February 2013. Things peaked with an indecisive doji cross, but a doji cross that was so much more, as it was day 2 in a 3-day bearish evening doji star pattern, and prices dropped down to close yesterday below the medium moving average and on the congestion at 21,355 because of that 3-day pattern. Last week I said, and I quote, "The action since late August has caused me to think that perhaps the action is a possible descending scallop pattern. I would like to see more on this to be sure, but right now it looks a lot like that to me. I'm minded therefore to give just a provisional idea on the upside for such a pattern, assuming of course it does not peak and revert back down, which would also be in line with this pattern. But for a continued move higher, you would have to look primarily in the 25035 area, and possibly later on should it continue up to the 27475 area. I'm not ready as yet to start naming targets for this pattern, but it is worthwhile being prepared, just in case, as I can easily discard these if they prove unsuitable." End of quote. I'm still minded to look at the action as a possible descending scallop pattern, as the fall these last few days is in line with such a pattern. However, I think I will discard the potentials, not targets, but potentials, I have previously mentioned, until a better picture emerges. If we do see a continuation of the pullback lower, then for this pattern to survive, it must not be more than the low in late October of 17,350, and ideally no more than 17,525. Therefore, this pattern is still in operation. Just pay close attention to what happens next, as it will affect any fresh potentials on the upside. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.